We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Kevin Muir, author of The Macro Tourist. How are you today, Kevin?
Great. Good to be with you today, Tom.
Great to have you back. And thanks for accommodating on such short notice.
It's my pleasure. It's great to always chat markets with you.
So in September 2019, we heard about the repo market freezing up. And a lot of people kind of scratched their heads and had never really heard of the repo market. So why don't we start by explaining to our audience what the repo market is?
Well, so the repo market ends up being the short end of where dealers lend to one another. And I think that when we start talking about this, it's kind of actually more important that we actually step back and to think about the entire yield curve and all the different parts and what you're trying to accomplish. So if we think about kind of the short end of the curve, meaning that's like 1 month and or even 1 day or 3 month, that's where the vast majority of kind of transactions in the financial markets are executed. And although it's not something that we pay much attention to, it's kind of what you would think about as the financial plumbing of kind of the entire system. And there's a lot going on there. It's a lot of banks lending to one another and going back and forth. And so, you know, there's very few kind of regular folks that are actually focusing on that. Most of us sit around and we think about the 5-year, 10-year, even 30-year bond. And we're not thinking about the front end of the curve. And it ends up being that front end of the curve and all those different instruments and all the different parts of it end up giving kind of like it's almost as if you think about it like a temperature of the economy and a temperature of the financial system. So that might be a way to kind of think about it. If the repo market is acting up, it means something's not quite right at the front end of the curve and that there's some problems in the plumbing and maybe, you know, the patient is a little bit sick.
So the main purpose of why I wanted to have you on today, Kevin, is that you recently wrote an article entitled Overnight Reverse Repo Program Arbitrage, right?
Right.
And so we've heard a lot about the reverse repo program if you've seen that lately, and It's spiked to all-time highs. So kind of give us an indication of what that program is too.
Sure. So if I can, I'd actually like to step back and kind of even go one step before this because there's a lot of parts to get us here. So let's just start with before any of these special monetary policies came into being. And what happened was in the great financial crisis, interest rates went to zero. That's in the 2008 and 2009. Interest rates went to zero. And the Federal Reserve was stuck with trying to figure out a way to stimulate the economy, you know, with interest rates at zero. In the past, they had lowered rates, you know, from 2 to 1, and that had helped the economy. But here we were at zero, and yet the economy still needed help. So they came up with this program, and it's called Quantitative Easing. And quantitative easing is simply the Federal Reserve going out into the marketplace and buying bonds. And they can buy a variety of different length bonds. They will go and they'll announce it and they'll say, we're going to buy 5 years or we're going to buy 10 years or 30 years. And what the thinking is that they buy the bonds from the marketplace. And so they're buying it from the economy and they're pushing out kind of capital or cash into the system. And when this first happened, there was a lot of people who thought,
sorry, Kevin, can we make a distinction there? What type of bonds are they purchasing? Are these corporate bonds?
Yes. So when originally they start with treasuries, then that was solely treasuries. And because for a long time, the Federal Reserve, the Federal Reserve, was only allowed to buy bonds that had zero credit risk. Okay. The Congress had told them that they're never allowed to lose money. And if they're buying a bond that's a corporate credit, then they potentially could lose money. So they go out and they do these quantitative easing programs. They go buy the bonds. And what happens is they buy it from JP Morgan. JP Morgan sells them $10 billion of 5 years. And JP Morgan now has $5 billion of, you know, cash on their books. And the idea about that is that they would then go out and lend it. And so they would lend the money out into the system and this would get the economy going. And when this first happened in quantitative easing, there was lots of people who thought this would cause all sorts of inflation. And there was that famous op-ed in the Wall Street Journal that was signed by a whole bunch of people that very famous people, Jim Chanos and a variety of different very accomplished money managers signed it saying that this was going to cause inflation and that he should immediately stop it. Well, we found out that that was not the case. And the reality is the reason it's not the case is because if you think about JP Morgan, do you think Jamie Dimon goes and lends money based upon what the Federal Reserve buys or sells from him? He doesn't change the bank's balance sheet in terms of the loans that it's going to create based upon how much cash it has on the books. They change their balance sheet based upon the creditworthiness of the borrowers, what their balance sheet looks like, all sorts of different variety of factors. So the reality is that JP Morgan doesn't change based upon whether the Fed buys some bonds and puts some more cash on their balance sheet. They change based upon the demand for loans and their own particular equity and capital situation. So contrary to most people's, worry, quantitative easing did not actually cause any inflation in the traditional sense. And I want to stress here in the traditional sense. And I'm going to take you back to 2009. At the time, I was trading for myself. And, I was probably bearish on the stock market because most people coming out of the financial crash were bearish. And I would get up every morning and, I'd start trading and the stock market would look weak. And I would see a situation where, okay, here it is. This is it. The stock market's going to crack, and I would lean into it. And then all of a sudden, at like 11 o'clock, the stock market would get a bid. And I would be like, what? What's going on here? Where did this bid come from? And inevitably, the stock market would go higher and, I'd cover and wake up the next day and try it again. And it just kept going on.
You were shorting the market, expecting it to crash, right?
That's right. But it became, these bids came out of nowhere. They just unbelievable. Like it was just unexplained, no news. All of a sudden there's a bid. So this went on for a while. And even I'm not stupid enough to do that for very long. So I eventually stopped doing it. And then I kind of stumbled upon this thing was quantitative easing. And, back then, very few people understood what was going on with quantitative easing. Very few people even knew about it. Most stock guys, if you had told them, didn't have a clue. Well, I looked at this and I realized that the days that with the bids in the stock market, where I saw this bid, materialize out of nowhere, coincided with the days that the Federal Reserve was in there buying bonds. Now, I know lots of kind of pure economists will tell me that there's no way that this can be, that this is just in my mind and there's not such a direct link. I beg to differ because what I did was I actually made a spreadsheet and started tracking these things. And I looked on the days when they were buying and I realized that the stock market went up more than on the days that they weren't buying. And I'll tell you one quick story about a subscriber of mine. After I told this story, he reached out to me and he said, listen, I work for a hedge fund. And one of our biggest clients is the GPIF, which is the government, is the postal service in Japan that happens to be the world's largest pension fund. And what they do was on days when the Bank of Japan would go do quantitative easing, meaning when they would come in and buy bonds from the marketplace, inevitably, because the Japanese Postal Service, the GPIF, were the biggest holders of these, they would sell them. And when they would sell them, they would turn around and then the next day, this guy would get an order. And this guy would get an order to buy, like they would go invest in their hedge fund or they would go and buy more risky assets. So I came to the conclusion that although the Federal Reserve's quantitative easing program did nothing for actual inflation, I became convinced that it actually affects financial asset inflation. Okay. Now, this eventually became kind of more standard and more accepted amongst the Wall Street community. Okay. And then eventually what happened was the Fed stopped doing quantitative easing. And in fact, they did tapering. Now, let's go to today because it becomes a lot more complicated. The Federal Reserve is doing quantitative easing on a regular basis now. Okay. And I can't remember what the number is. I think it's 120 billion a month or something like that. It's a big, big number. And what we've almost become numb to the size of these positions. And I remember actually during the COVID crisis that I signed up for the Federal Reserve's kind of email alert system where they show you what they buy every day. And there was a month there in the height of the of the panic when they were sending me stuff, and I would look through this spreadsheet of stuff they bought, and I was just flabbergasted. I was floored. You'd be looking and it'd be like 500 million of this issue, 400 million of this issue, 220 of this issue. And you just think to yourself, holy smokes, they are just buying everything. And so the COVID crisis has kind of thrown a lot of monkey wrenches into a lot of different parts of how our economy works. And there's no doubt that the quantitative easing that we've seen over the last year has helped the stock market go up. And nobody's really denying that. I think that the Federal Reserve and even the government officials will agree with you there. You alluded to earlier the fact that the original quantitative easing was actually only done in the government security fixed income market. It became such that in this COVID crisis, they actually figured out a way to make it so they could buy, private corporate credit. And the way they did that was they allowed the Treasury to take the first loss so that theoretically there'd be very little chance of the Federal Reserve having any default risk. And in doing that, they were able to basically buy bonds from Apple, Microsoft, and a whole host of different kind of private companies. The Federal Reserve has basically just been buying everything with a QSIP. And just if it's not nailed down, they've been buying it. Okay. Now, the story gets a little more complicated, and I apologize, but the reality is that this is a complicated topic, and you have to understand kind of how it all plays out to understand the strange effects that it might have in our economy and unintended consequences. So one other kind of topic that we have to talk about is something called the TGA. The TGA is the Treasury General Account, and you might think about that as like the checking account for the Treasury. Now, the Treasury is like anytime the federal government spends, it'll go through this checking account. Okay, so the Federal Reserve sends out unemployment or sends out, let's just say aid to airlines. It'll go through this account. Now, in the old days, the Treasury General Account was a very small kind of thing that didn't really get run up and down that much. Maybe they would be, 100 million in there. And then the moment that they looked like that they were running out of money, they would go out and borrow more money and stick it in there. And it would be just kind of back and forth. In the Obama administration, they actually reached a point where they were worried about, I guess, a budget disagreement and the worry that the government was going to shut down. So they figured out a way to actually pre-fund it, meaning they went and they sold T-bills or other Treasury securities so that they had a higher balance in their checking account. Now, if you stop and think about this, usually when the government spends or, sells T-bills, they're spending on the other side. So somewhere, although they're going and taking money out of the economy by selling these bills, they're spending it somewhere else. So on the whole, it's a net zero, right? Or it's not quite net zero, but there's a positive and a negative to that side. Now, when the Obama administration first did this, they went and they pre-borrowed. So in essence, they went and they took money out of the financial system, but yet didn't spend it, didn't put it back into the real economy. So the reality is that when you start to watch this, you realize that this also affected the stock market. And this was part of the reason that when you saw Trump win, when he won the election, one of the first things that Mnuchin did was run down the TGA. Now, if you think about a government that's going out and spending money without having to borrow, it's like there's all positive. There's no negatives to it, right? Like usually when a government goes and spends money, they have to borrow money on the other side of it. So there's a kind of a plus and a minus. Well, what's happened here is that you've kind of changed the timing of those cash flows. You pre-borrowed and you've taken the negative hit on terms of taking money out of the system, and then you've pushed it off into the future. Now, during the COVID crisis, Mnuchin, who was then Treasury Secretary, ran the TGA account up to unheard of levels. Previously, it had been almost nothing. Then under Obama, I think it had gone up to 400 or 500 million. Well, Mnuchin went and he pre-borrowed $1.6 billion. Trillion, I'm sorry. I'm getting so, you know what the problem with all this stuff is? You get into these situations where we kind of think a billion's a big deal and it's actually trillions. I'm sorry, all these numbers should have been billions. So Mnuchin borrowed $1.6 trillion. $1 trillion is like an absolutely monstrosity of a number that we just get. Like, I think the whole banking system is like $2 trillion in terms of like cash circulating. So he borrowed $1.6 trillion. And there was some talk that he was going to go and spend that right before, Trump was going to get elected and try to goose the economy, but he didn't. So then what happens is we get a situation where, Biden wins and Yellen's sitting there and she's now Treasury Secretary and she has this TGA account and it's not good. We shouldn't have this thing. So they work on pushing it down. So come February, they start to announce a schedule for running down the TGA. Now, again, let's just go over what the TGA does. It pushes cash into the system by the government spending, but it's cash that's already pre-borrowed. Okay, so there's this cash coming into the system, but it's already pre-borrowed. So now if you're thinking about this from a kind of an economy point of view, this thing is going to make the economy fly. And there's no doubt about it. It's been part of the, why we're seeing lumber go up and why we're seeing corn go up and why we're seeing all these, great economic numbers. Part of it is this government spending, pushing it out into the system. Okay. Now, what gets really, really strange about this is there has been so much liquidity pumped into the system that in essence, there aren't enough investment opportunities for that money. Because there's all of a sudden, they've gone and they've pushed in, all this money into the system. And not only that, during this period that the TGA is running down, the quantitative easing is still going, meaning they're still buying bonds and pushing more cash into the system. So all of these factors are pushing this liquidity tsunami, I called it, into the system. So you have all this cash at the front end, okay? Now this is where the repo market comes along. If the government didn't do anything, what would happen is that money would actually overnights would go to a negative rate, because there's so much money trying to find somewhere to invest that, on a safe basis, that you would have a situation where overnights would trade at negative rates. And you actually saw this for a little while. T-bills recently, last month, I believe, traded at a negative rate. And the reason was because there's so much cash and they couldn't figure out a way to deal with it.
There's not enough demand basically to create places for it. There's not enough demand, because they're not lending it out. They're not doing it. It's sitting there and they have to figure out a way to put it somewhere overnight safe. Mm-hmm. Okay. Now, so what the government does is they go and they offer this overnight reverse repo program. Okay. So what that means is they go and they say, listen, I know you have all this cash. You give me your cash. I'll give you some collateral, some of these bonds or whatever I own overnight. And what'll happen is you'll earn the rates. It might even be zero. I don't know what it's clearing at these days, but it's clearing 1 basis point or whatever it is. And that stops it. It in essence creates a floor on rates so that they don't go negative. So they are, in essence, withdrawing liquidity at the front end. Now, this is just crazy, because think about this. They, on one hand, are doing a program that is almost like quantitative tightening, meaning that they're withdrawing liquidity. So they're withdrawing liquidity at the very short end, but at the same time, they're going and they're pushing liquidity at the long end. So there's so many different parts of this kind of thing going on. The Federal Reserve is going and they're doing quantitative tightening, or a form of quantitative tightening at the front end. Then they're doing quantitative easing at the short end. At the long end. And then meanwhile, you have the TGA doing it's a lot of different moving parts. Now you might say, why don't they just do less quantitative easing? And that would actually be the one of the easy solutions to this problem. But remember, the reason that we have a kind of
a problem with the overnight reverse repo right now is because they're running the TGA down, meaning that they've gone and they have this 1.6 trillion and they're trying to push it into the system. So why they don't go and just reduce QE is because they would have to reduce QE and then they would have to put it back on. So they don't want to confuse the market and they don't want to be giving signals. So they just say, listen, we're going to keep going with QE, but we're going to figure this thing out at the short end to, mop up the liquidity. And thinking about that, you mop up the liquidity. Okay. So now this is kind of the really big revelation that I had. So I hang out sometimes in these, they're called STIR, and they're short-term interest rate traders, okay? And these are the people that are sitting around and they're trading overnights and they're trading, euro dollar futures, and they really are really knowledgeable about the plumbing of this thing. And they've been talking about, I'd seen this, they've been talking about all of the problems with this kind of overnight repo and all the issues with the bank stresses on the bank's balance sheet. And I thought they were full of it. I was like, no way. Like, there's not a chance. Like, we're getting all this liquidity into the system. How could that possibly not be positive for risk assets? And that's, in essence, what I kind of, for a while there, I just assumed they were wrong. And then from the work of this fellow by the name of Barton, and I think you can go check out his website at fed.tips. I believe that's it. And he's a fellow that actually has followed the kind of plumbing very closely. And he went through and he showed me how this was affecting the market. And he gave this argument. And the crux of it is that when this liquidity gets pushed out into the system, the banks have a higher charge on their capital. And it gets complicated because, yes, they can shed it through this account called the interest on excess reserves, but there's other times that it's more difficult to do, and it depends on the different counterparties. But the long and short of it is, when there's this push out into the system of all this capital, and then when that eventually gets deposited at JP Morgan, they end up having to take an increased capital charge for that asset that's sitting there. And when they do that, because they have rules about how much risk they can take based upon different things, and it has to do with this change of this rule called the Basel III, which is a bunch of bankers that get around and argue about the way it should work. But because of this kind of capital requirement, when this liquidity gets pushed out into the system, these banks have to cut down on risk on other assets. And so what they end up doing is they end up cutting back generally on exposure to hedge funds and other real risk takers that they've been extending balance sheets to. So what you see is kind of paradoxically, even though you would think that the TGA getting wound down and capital getting shoved into the system would be positive for risk assets, what you see are on the days when a big, huge check goes out and all of a sudden there's all sorts of new deposits at the banks, that the stock market would sell off. So now this is my kind of contribution to this, because although, Barton's a great guy and I thought, he kind of sold me on it. I thought, I'm going to do my Ronald Reagan impersonation. I'm going to do trust but verify. And so I went and took the days of this overnight reverse repo program, which is the government's, how much liquidity they're mopping up into the system. And I measured the change, meaning I looked at it from day to day. And what I found was, on the days when it increased by 20 billion or more, the stock market, now this isn't from a period of March 31st to present, because this is a relatively new phenomenon. On those days, when it increased, meaning that there was more reserves pushed into the system and these banks had to deal with it by cutting back on risk, the stock market had a negative 26 basis point return. Okay. On all of the days combined, when I looked at this period, it was actually plus 16%, 16 basis points. So what you're seeing there is that there's huge underperformance on the days when the liquidity gets pushed into the system. Then ironically, the days that it gets removed and the days that you see a decline in the reverse repo, meaning, that they don't have to sop up as much liquidity. The stock market had a positive return of almost 80 basis points. So I saw this and I was like, oh, this is just, although it almost seems counterintuitive, you can see it in the market and you can see the actual results. And my joke is, those two economists that go down the street and they see $100 bill and one of them goes to pick it up and the other one says, no point. If it was real, somebody would have picked it up. Well, I'm going to let those guys argue about that. Meanwhile, I'm going to go trade it. And I think, to me, that there's a real edge in this overnight reverse repo. So that's a long-winded answer. I hope I did it justice, Tom.
You absolutely did, Kevin. And it is a very tough subject to understand. I went through the article a couple times to try and understand it myself. But why don't we start kind of by, I want to ask if once the TGA is wound down to, let's say, whatever they consider an acceptable level is that by extension going to bring down this reverse repo program as well?
Yes. So I think that we're going to see, as the TGA, as they stop pushing kind of reserves into the system, we're going to see a natural falling of the reverse repo. And I think that's going to be positive for risk assets. And I actually have been trading it for the past couple of days. If you look, you can actually forecast the reverse repo. And like tomorrow, we're taping this on Friday, on Thursday. So on Friday, Barton is forecasted it should go back down. And so I suspect that will be kind of an up day. And I've been looking at it. We've had 8 days of this thing increasing. And although yesterday and the day before I was leaning short, especially in the afternoons, I've now kind of started to go the other way based upon this. Because ultimately, although there are negatives on the days when there's too much liquidity into the system, once they start to be able to deal with that and it starts to figure it out, it's still going to be risk positive. So on the whole, the winding down of the TGA and pushing this liquidity out into the system is risk positive. The only kind of little caveat being that on the days that it comes in, it causes a short-term disruption and stocks don't do as well.
So Kevin, is this, we heard when the repo market almost froze up, that this could have caused a real issue. Does the reverse repo program pose the same possible risk?
No. Listen, generally all of these, when equity guys start talking about the repo, you almost know it's almost over. Like the reality is that, when you start seeing it on those famous doom websites out there and it starts making the headlines, that the problem will be solved. Generally, it's a problem of plumbing, and it happens to be that one particular institution or whatever can't figure it out, and the Federal Reserve gets in there and they change the plumbing and they do it. And this really just, the reason for this one was because the numbers were just so large in terms of how much they were pushing out into the system, that there was this unintended consequence that people don't know. The other thing is that I'm not sure that the Federal Reserve was that upset about the banks having to take less risk. That this causing the stock market, to have a little pause. Because the reality is that the Federal Reserve, although they are determined to offer easy monetary policy to ensure that as many Americans have jobs as possible, there is no doubt that there are some of them that are worried about the consequences of a bubble, and meaning that financial assets go up. Now, in the past, I think that Jerome Powell was actually very much in that camp. And if you go look at when he first took office, I think in February of 2018, the best kind of indicator of monetary policy in terms of getting a feel for what it was actually set at is I like to look at the 2-year tip yield. So the 2-year tip yield is kind of an expectation of, in real rates terms, meaning like after inflation, of what the government, of policy over the next 2 years. If you look at the 2-year tip yield, up until Powell took office, it had kind of gone in a range of 50 basis points and minus 150 basis points. Because don't forget, it's inflation plus that yield. So in a case where, inflation's, 150 or whatever, 175, you can have minus 150 yield and you'll actually have a positive nominal amount of 25 basis points or zero or whatever. So, and the reason that it was in this range was because Bernanke and Yellen kept monetary policy relatively dovish. Like they were not trying to be hawkish. They were not trying to get out ahead of the curve. Well, what happened was Powell came and Powell looked at the bubble that was brewing in the stock market. And I don't know, maybe not bubble, enthusiasm, exuberance, use whatever word you want to use. But he looked at it and he said, the consequence of a bubble bursting and then having to clean it up is a lot greater than we give credit for. Therefore, I'm going to try to get out ahead of it, which was very different than Greenspan, who had fully well said, you know what, I don't know how to define a bubble. I don't know where it is. And plus, we can always fix it later. So, I'll clean it up after. So Powell's, determined that the years of this policy were different. That he was going to view it as different than the previous three Fed chair people, right? So he came out and he raised rates and he raised rates and he raised rates. And that 2-year tip yield went from 50 basis points to 200 basis points till finally he got to the point where he said, we're a long way from neutral. And at that point, we had the stock market start to sell off. And like, if you go look at that period, long way from neutral, stock market sold off for the next 2 months until finally he was forced to say, oh gosh, I've gone too far. This is a problem. And then that famous kind of capitulation on the Christmas Eve where they finally gave in. But my point about this is that, from then, Powell never decided he was going to go out and prick a bubble ahead of time, right? Because remember, Trump was yelling at him, telling him that he couldn't putt, and there was a million things like that. And I argue that was the last central banker that's ever going to try to go out and get ahead of the curve. They're not going to be ahead of the curve. So going back to the kind of the recent developments with this overnight reverse repo, although the Federal Reserve wants to keep rates low and like zero for as long as they possibly can, they do not want to create a bubble. So if there's a policy that will keep financial assets down while keeping like rates down, they're not that upset about it. Is my point about that. So therefore, I don't think you should kind of get too worried about it causing a crash, because the moment they want to, they can fix it. And then not only that, it's just not the right kind of problem that causes a crash.
So in that vein, Kevin, are you looking at any risk factors or trying to pay attention to any risks that you see that could be causing a crash?
So ultimately, I think that any crash will be caused from inflation finally getting out of control. And so ultimately, that's what you need to ask yourself. Does the Federal Reserve lose control of inflation? And I think we're miles away from that. I think even now, even after all of the hysterics about things like go pull up the 10-year yield. Yeah, it's gone up a long way, but go pull up a 30-year chart. We're ages away from it. And I just don't see them losing control of the long end of the bond curve for a long time. And I guess I would also define what is losing control of the long end of the bond curve differently than from other people. A lot of people think that long end, being at 4 or 5% will be the end of the world. And I think it's going to be fine. Like, I think it'll be good for our economy to have rates higher at the long end. And I think that they want it, and it'll help the banking system. And there's lots of positives to having a yield curve that's steep and having those things. And so I think that all the people that talk about yield curve control, which is what they in essence the bond bulls start, saying, oh, we're going to have yield curve control the moment that yields go up, 25 basis points. I say, no, I think the Federal Reserve wants that. And I think it's going to happen. The only question is, does it ever get out of control? Do you ever see a situation where rates, instead of going up, 5 basis points a day, start jumping 50? And to me, I think that's what's more important than kind of the absolute level is the rate.
The rate of the rise versus the absolute level.
Yeah. So all of a sudden you saw a situation where bonds just went no bid and they were going up 25 or 30, 40 or 50 basis points a day, then yeah, that's going to cause a lot of problems for the stock market, and that's going to, there'll be issues. But, if we wake up a year from now and rates are up 100 basis points from here, I don't think it's going to be an issue. And ultimately, I think that inflation will be the kind of the stock market's biggest worry. But having said that, I think that it's also going to depend on what kind of stocks you have. And I think that you ask about, like, are you worried about that causing problems in the stock market? I would say that I'm worried about it causing problems in the stock market of the portions that most people own. Like, most people own growth, technology stocks. And if you think about growth technology stock, it's the longest duration asset there is out there, because all the growth is in the future. And they've been, a huge beneficiary of the kind of decline in interest rates and the lack of inflation. And it's been a perfect environment for these people. Or for these companies. So I see a situation where I could see some real pain in people's portfolios because they're too overweight all those stocks and not, long enough of the actual stocks that'll do better in a real economy. And that's really, to me, my big theme going kind of in the next years and decades, is that I think you're going to start to see Main Street over Wall Street. We've had years and years of labor losing and labor's force, share of the GDP going down. And you go listen to Biden, you listen to him, he talks all the time about unions. He talks about the little guy. Things are changing. And so I think what you're going to find is that this is going to mean dramatic changes in people's portfolios. And so I'm actually more worried about people's bond portfolios than I am about their stock portfolios. Because I think that's going to be the part that really hurts you. If we have, a decade of inflation at 3-4%, there's going to be a lot of destruction in the long end of the bond curve.
So this is kind of tied into, you wrote another article where you renamed transitory inflation to ephemeral inflation, right?
I people get so fed up of hearing about transitory inflation, and they I thought I should pick another name, and so I chose that one. I think that a lot of people, the problem about, the stock market or the financial markets is you go and you listen to people and you see what they're saying, and you think to yourself that it must be that their portfolios are set up a certain way based upon the way that they're speaking. And then you look at the market and you're like, no, that doesn't make any sense. Like they're saying one thing and yet it's not priced that way at all. So in the case of this, transitory or ephemeral inflation, if you kind of think about it, if it was true that everyone was worried that it wasn't transitory, meaning that they don't believe the Federal Reserve, which is kind of like when you hear, legends like Stanley Druckenmiller get up there and he talks about, the Fed making a policy error, and you hear all these people, you think to yourself, well, geez, they must be, positioned this way. But then you go look at it and you realize that the market completely agrees with Powell that, that inflation is going to go and it's going to be transitory. It's going to be short-lived. And the way that I did this was I went and pulled up what's called inflation swaps. And inflation swaps are basically just kind of a contract where two parties agree on, where they buy and sell, inflation over the next, whatever the term of the contract is. And you'll see that yes, they're going up across the board, but they're going up way, way more at the front end of the curve, meaning that 1 and 2 year inflation swaps are way higher. And then if you go look at the longer end, they're barely up. So the market definitely thinks it's looking at this and it's saying, yeah, it's going to be kind of a flash in the pan. We're going to be back to normal within a year or two. So I look at it and I think that even though there's all this worry and this kind of let's just say, angst amongst the financial community about inflation, the reality is that they haven't changed their portfolios. And so I view this as a real opportunity, because to me, I think that the angst is well placed, because I believe something fundamental changed during COVID. I believe that we went from kind of what my friend Lynn Alden calls a society of monetary dominance, meaning that we tried to solve everything with lower rates and monetary policy, to one of fiscal dominance, whereas we go and we actually spend the money. And we went through why quantitative easing doesn't actually cause real inflation, because the reality is that banks don't lend based upon how much reserves they have in the system. They're not reserve constrained. So we've kind of come to believe that governments cannot create inflation. I've never believed that. I think governments can create inflation. They create it by doing fiscal, meaning that they go and they spend more. And there's two ways that we can create money in this, in our financial system. One is when private banks or private institutions lend it into existence. So Tom, when you go take a loan from your bank and go buy a house, the reality is that they don't have all that, the money that they're lending you. They're creating that money. And we've focused on that for the past 40 years, ever since, Volcker broke the back of inflation through monetary policy. We've used only that tool to kind of affect the kind of economy. Well, the reality is that there's another way that money can be created, and that's by the government spending it into existence. And ironically, when we had the great financial crisis, because we had gotten there with the problem of too much debt, the government went and did more kind of pro-cyclical cutting when the government should have been doing the opposite, meaning that during the great financial crisis, nobody was willing to borrow, nobody was willing to spend. At that point, the government should be spending. Yet, what did they do? They did the opposite. They started, cutting because they were worried, too much debt got us here. Well, now COVID has kind of brought about a change in these policies. It's brought about an acceptance of this, school of economic thought called MMT. And I know you and I have talked about that in the past. And with that school of, that acceptance, we've changed the narrative. And, you were just telling me today that the government's talking about a $6 trillion deficit or budget. Like, these numbers are huge. And we're willing to spend more. And although, a lot of times when I'm in my trading, I always say, don't worry about what should be, don't bother arguing about it, just figure out what will be. Mm-hmm. And in this case, I look at this and I go, regardless of whether you think this will end badly or not, it's going to happen and they're going to spend more. And given that, I think that you can say that inflation is going to be more of a problem going forward. I just don't see us going back to the days of balancing budgets. And so for me, when I look at the biggest risks out there, I'm not worried about the stock market as much as I'm worried about the bond market.
So when you were saying that basically that inflation isn't a problem right now, is that basically, or it brings two things to mind for me. The cure for high prices is high prices, right? And I also had recently Danielle DiMartino Booth on, and she was saying that the inflation numbers look really bad, and it kind of panicked the market simply because, as a comparison to this time last year, this year's numbers look terrible. But going forward, as supply chains catch up, as we also have a higher number to compare to, that contrast will come down. Is that right?
Right. That's called the base effects. Mm-hmm. And in essence, because we're always looking at a year-over-year change, if you went in March of 2020, when COVID came, we had basically a decline in a lot of prices because we shut down our economy. Mm-hmm. And so the prices went down. And so when we were looking at going into February, like February of this year, of 2021, we were still comparing ourselves to February of 2020. And at that point, prices hadn't yet gone down. Mm-hmm. So the reality is that in March, April, and May, those numbers, even if we didn't have any inflation, it would still register as a positive number because we're comparing ourselves to a year period of, a year ago when it had gone down. Mm-hmm. So that's called base effect changes. Even with the base effect, though, inflation has run hotter than people thought. So there's no doubt about it. I would, I kind of ask, go back to March of 2020 when the world was ending and everyone was convinced that the stocks would never rally and that the government couldn't save us. And I know it seems kind of quaint now, but there were so many bears and there were so many people saying that the government has no room, the government can't do all these things. And they were remembering 2008. And in 2008, the government did have trouble. And the reason the government had trouble was because they didn't spend. And this time, the government understood that. And they did the largest fiscal package that we've ever seen. And lo and behold, the surprise wasn't how bad the economy was. The surprise was, boy, the government can affect the economy way more than we ever thought. And this is part of kind of my belief that society has gone through a wake-up call about the power of fiscal. And that's what I think that they've realized. And I'm always hesitant to say this because like MMTers will argue that they're going to be able to control the inflation. There's not going to be abused, and everything's going to be great, and it's going to be rainbows and unicorns. And I always say, the reality is that we as humans abuse everything. And I look at monetary policy and I think like, geez, when you have rates at negative 50 basis points at the ECB in Europe, you're telling me that wasn't abused? Like when you're looking at these things, we abuse things, and it's just kind of the nature of human beings. So I think that what's going to happen is that this is going to work, and then we're going to be surprised at how well it does. And it's going to feel great at first, and then eventually it's going to cause a problem. And like, I don't think that means that we shouldn't do it. Like, that's where I probably differ. Like I kind of look at it, what's that joke about democracy is a terrible form of government. It just beats all the others. Mm-hmm. Like, and to me, to some extent, that's where we are right now in terms of fiscal policy. Yeah, it'd be great if we didn't have to do this, but the reality is that's the way we're set up and that's the way we're headed. And so instead of sitting there and getting sanctimonious about it, or, trading, talking about how this is going to all end badly, figure out where it's going and adjust your portfolio correctly. And to me, it's pretty clear that it's going towards more inflation. And yes, it's going to ebb and flow. And could we be in a situation right now where it's going to ebb a little bit after flowing so far upwards? No doubt about it. Like, the next, 20, 30 basis points in yields might in fact be down, not up. Like I won't deny that at all. But I'm pretty confident that the next 200 or 300 are up and not down.
So, Kevin, as a real macro focused guy, can you define or how you see inflation for us? Because I know the traditional Austrian definition of inflation is an expansion in the monetary supply, right?
Right. Yeah. So.
Because there's so many different, seems to be so many different definitions of inflation, right?
Yeah. And, like the whole money supply thing kind of bothers me. And like the other one that I think it's funny that when people start talking about the velocity of money, like it's actually something that's real that you can touch almost. And the reality is that the velocity of money is a plug-in factor after the fact. After you have the money supply growth and you have the GDP, you figure out the velocity. But the velocity isn't something like real in the way that that it's often portrayed. Inflation's tough because there's different inflations too, right? Like we've experienced lots of inflations in different parts of it, and if you go look at the credit that extended to, let's say, students. There's been a huge expansion of student debt out there, and the government's been willing to do that. And you go look at the student cost of tuition, textbooks, dorms or whatever it is, and you look at that. We've had massive inflation. Like it's huge. It's I don't know what it is, 300-400% over the last couple of decades. Like it's monstrous. And there's no doubt that inflation is also it's kind of jiggered to make it lower than it should be. Like, are you telling me that when your car
CPI, right?
Yeah, I'm sorry, I should have been clear. The traditional CPI is this whole hedonics, or I don't know how you say that. Is it hedonics? Anyways, this whole effect of kind of a changing it based upon the improvement in the good. And meaning you're telling me that when your car goes up from 200 horsepower to 225, that it's gotten that much better. And I call bullshit on that. It's crap. And your iPad might go up in 10% in price, but they'll say the chip's twice as good. And so it's really going down in price. No, that's not how it works. And so I have no doubt that inflation is understated because of those effects. And I have zero doubt at all about that. And I don't know if I worry too much about how to define it exactly. I do think that we're going to see more of it than we've ever seen. And listen, the other thing we haven't spoken about is I believe that in the last 20 years, we've experienced a huge wave of globalization. between the fall of the Iron Curtain, like the Berlin Wall, and all those people coming into the workplace, and then more importantly, when China joined the WTO, we've had this huge labor supply shock. And I would argue that that's probably reached its pinnacle, and we're actually now going towards deglobalization. And if you think about what globalization did, globalization created disinflation or deflation, and it kept interest rates lower, right? And so to me, if we have the opposite from globalization, I think we're going to see, inflation going up and interest rates going up, because that's, we're going to have it in reverse. And I look at China and I say the days of them pushing down on our kind of inflation and our interest rates are gone. And I think that's another huge macro shift that people haven't really kind of come to terms with. Like I'll leave you with this, Tom. In 1981, Volcker came and he broke the back of inflation, and he ushered in the next 4 decades of kind of monetary dominance. I think that COVID, in essence, broke the back of monetary dominance and ushered in a new wave of fiscal dominance. And a lot of the trends that we've seen that were in place for those 4 decades will now be in reverse. And I would argue that most investors have not accepted that, and they're definitely not positioned for it.
That's a great point, Kevin. And I recently interviewed Marion Katusa as well, and he's saying that MMT is coming, basically. And there was a lot of kind of pushback on that after the interview that I saw in the comments that said we are there, we're not there. So as you say, this shift to fiscal dominance, how do you, and this is something that you and I have covered before, and I think it's really important to understand, and it was a great discussion that we had last time. How do you define MMT, and do you think that we're basically already there or not?
Okay, so for me, MMT is a descriptive process as opposed to a prescriptive process. So I don't think you can quote unquote do MMT, which is what people claim. And a lot of MMT policies have been adopted by the left, and therefore people associated with the left. Well, the reality is that MMT is equally could be used on the right. You could argue, and I have argued, that Trump is the most MMT president we've ever had. You go look at what he did. We were 6 or 7 years into an economic expansion, and what did he do? He cut taxes. Why did he cut taxes? They asked him, why are you cutting taxes? Why do you want rates lower? And he goes, because there's no inflation, which is the exact, argument that an MMTer will make. MMTers believe that there is no financial constraint on the government. There is only a real resource constraint. And because of that, the government should always go and run a fiscal, let fiscal go to the point where they're competing with the private sector and creating inflation. And failure to do that is actually creating an environment that is where your society is producing less than it could. So why do we have an unemployment? Why do rates go up the moment we get to 5% of unemployment, or whatever the NAIRU or whatever it is, the natural rate of unemployment? This whole kind of idea that the moment that we get to a certain amount that of unemployment, we have to actually raise rates is kind of ridiculous. When you actually stop and think about it, you're almost tuning the system for people to always be unemployed. It doesn't make any sense. And so I know I can hear in your comments already people saying, oh, you're going to let inflation run hot. You're going to learn the hard way. Yeah, I don't doubt it. Listen, I'm the first one to tell you that I think this is going to end up with too much inflation. I just think that the tide is turned. And back to your question about, how do I define MMT and are we doing it? I don't think anyone does it. I think MMT is a school of thought that explains how an economy works. And then based upon your understanding about how the economy works, we as a society can make decisions based upon that. I would argue that the last few years have seen an increased amount of regular old school economists embracing the concepts that had previously only been for MMT people. And they've done remarkable job, explaining how the economy actually works. I think QE is a perfect example. The MMT people, I wish I had known about it back in 2009 because they were the first ones saying you're not going to create inflation. There's no way that that's actually going to do that. They understood that. Same with like the European Union. They understood very much, like if you go look at the father of MMT and with Warren Mosler and Stephanie Kelton, they were warning against the EU all along, saying that this isn't going to work because of these reasons. A lot of their actual kind of thinking is very applicable to how, like, to traders and to understanding it, because it's based more in reality. And I probably told the story last time, but like, I'm an economics major, and up until MMT, if you told me that I would have spent, hours upon hours watching a university professor lecture on the economy, I would have told you you're insane, because I found the whole economic, profession to be crap. Like I looked at it, they go, they're living in a different world. This doesn't help in terms of trading. It doesn't help at all. And then when I went and listened to the MMT people, I was like, holy smokes, this is how it actually works. And understanding the plumbing and how it works made it so that it made me understand how, things operate, and therefore help my trading. Mm-hmm. And so the long and short of it is that I think that MMT is taking great strides, and I don't think that it's something we do, but I do believe that we have made the shift from monetary dominance to fiscal dominance. But having said that, it's not something that we can't go back on. And me as a trader, I'm not going to sit there if all of a sudden tomorrow the Republicans get control of a house and we all, we see a situation where they can't pass budgets. I'm not going to sit there and keep telling you that we're going to get inflation, because I understand that if we tried to balance the budget tomorrow, that we would have, a great huge decline in the economy. And so therefore I'd be the first one to tell you that you should buy bonds. And I'm not it's not like I'm wedded to this idea. I think this is where we're headed. I think that I kind of think it's funny that when people tell me that we're destined to have deflation or disinflation, and I say to them, name another society that's ever collapsed because of deflation. I don't know any. I just don't know any. Yeah, well, there's been ones that have suffered, but ultimately, inflation, if we wanted to, we can always make inflation. This has been my main point, is that it's only taken the political will to create inflation. And we might, in fact, go back and we might lose our nerve, and we might, in fact, stop creating the inflation that they want. And I'm the first one to say, if they do that, I'll change my policies. But till I see that, I'm going to assume that this is going to continue. I think they've gotten a taste for it, and I think it only gets worse.
Yeah, those are all very, very valid points, Kevin. And again, you're making the point of you're not wedded to the idea. You are trying to evaluate the circumstances that are present and right. Position yourself accordingly.
Yeah. So
Kevin,
the other thing is, I do have my own views. If you asked me, if you made me the omnipotent dictator of of the economy and the Treasury and the government, I would have things that I would do. But at the same time, right now, I have no desire to I'm a trader and I make my living being, hopefully more right than wrong. So the reality is I don't want to let my personal beliefs about what is right get in the way of making money. Mm-hmm. And I find too many people, they get, hung up on this idea. So yeah, you might hate MMT, you might hate everything that they do, you might hate all these deficits, but even Stanley Druckenmiller, go look at him. He says all these things, and then he's flexible with his portfolio. He's not going to sit there and fight it. If it ends up being that nobody listens to him and stuff like that, he's not going to sit there and go, no, I'm going to be right, and he's going to keep doing that. He's going to go and make money. And so your goal as an investor / a trader is not to say what should be, it's to say what will be. And so make sure you never forget that. And that's ultimately, the one piece of advice I give everyone, because I get on FinTwitter, I get on, some of these, I see these shows, and it's just they're so busy talking about the optimum way to set up the economy and all these things and stuff like that. And that's a fine discussion to have. But last I checked, most of those people aren't making policy, right? Like
Or
they're
money.
not the one, right? And you and I, we're not making policy. Like, so, we can have our opinions. We could sit there and discuss it. And yeah, it's interesting and stuff, but it's not going to help anybody. Like, I'd rather help people figure out where it's going. And that's my goal.
Mm-hmm. Absolutely. Kevin, is there anything else you'd like to share with our audience as we wrap up here?
No, I just, it's always a pleasure being with you today, Tom. It's a lot of fun. And, I guess if there is one thing that I would say to people, it's that, when it comes to new ideas like that reverse repo program, is that be open-minded to different things. Like, for example, I was too slow. I should have done that a week or two ago. I should have figured it out before. I missed a couple of weeks of a huge edge, knowing that those things were there. And if you just keep your mind open to things and be curious, you'll be able to figure things like that out.
Yeah, and it's like you and I were speaking about before we hit record. There's just so many things to pay attention to. It's hard to kind of pick and choose where to place your attention. But
for sure, listen, there's what's that Chinese curse that you said? Like, may you live in interesting times. Mm-hmm. But it sure beats the alternative, right? In terms of the reality is that whenever I hear someone complaining, a trader saying that this is crazy time, when they see GameStop or Bitcoin or whatever it be that they're saying this is so crazy, I go, listen, this sure beats us all sitting around and nothing happening in the summer and nothing going on, because the reality is that there's a lot to be had and there's a lot of opportunities out there. So make sure you take advantage of them.
Perfect. Kevin, you're available on Twitter at Kevin Muir, and also your website, themacrotourist.substack.com.
That's correct. And if anyone's not a subscriber and wants to see some letters, just send me an email, Kevin@themacrotourist, and I'm happy to send them some notes. Thanks for tuning in, and thanks for having me on, Tom. It's always a pleasure chatting with you.
Absolutely. A mutual pleasure, Kevin. Thanks for your time today.
Take care.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.